eCore21. A lot has changed since we last met. But that hasn't stopped us in the multifamily world from being more responsive, more innovative, more proactive, and just plain busier than ever. We've all seen these headlines, but we're here at eCore21 to unmask the nuances of our current market and share the intelligence and insights that are driving our business today and will shape our success tomorrow. Today, you'll hear from leading experts and some of the biggest names in our industry. Ralph Herzka, founder, chairman, and CEO of Meridian Capital Group. John Adams, chief lending officer, New York Community Bank. Scott Waynebern, president, Limekiln Real Estate Investment Management. Tony Fineman, co-head of originations, ACORE Capital. Jeff Lee, president, NewPoint Real Estate Capital. Joseph Fingerman, Managing Group Director, Senior Vice President, Signature Bank. Get ready to unmask opportunities, possibilities, and the path to excel in this market. Please welcome your moderator, the founder, chairman, and CEO of Meridian Capital Group, Mr. Ralph Herzka.
Thank you. All right, so before we get started, guys, we have a 10-year treasury at 142. So you're allowed to leave the room if you have to lock a deal if it's with Meridian. So I'm just letting you know. Anyway, good morning, everyone. Welcome to eCore, and it's great to be here with a great group of friends and panelists and professionals in the real estate finance world. First, I want to thank all my colleagues at Meridian for all the hard work that they've put into making this successful. I want to thank the eCore team and Hirsch and Shalom and everyone here for all the exceptional effort that they put in. We have a really successful event and have a great group of bankers over here. So as we saw on the screen, everyone got introduced, but what I'd like to do is really ask everyone to introduce themselves. Quickly, 30 seconds, if everyone can pick up their mic, and just say who you are, say where you're with, and then I'll make sure to give a little bit of introduction about our relationship with every one of these individuals. So John, why don't we start with you?
Thank you, Ralph. And again, hello, is it? Yeah, okay. Thanks for having us. Thanks for having me. John Adams, Chief Lending Officer, New York Community Bank. This is my second time here at eCore. I guess eCore19 was the first go around. Unfortunately, last year, we all know what happened last year. But we are pretty much on our path to be one of the more successful years we've had in a while for multifamily. Primarily, as you know or you've heard, we've reached out geographically. So looking forward to seeing you all after the panel, and perhaps we can do some more business together, obviously through Ralph. Thanks.
Thank you. So I just want to say, John runs New York Community Bank. This is a 30-year relationship that we have developed. We've done over $150 billion worth of high-quality business, and I want to thank so many of my clients that are in the room that have just demonstrated the tremendous relationship that this bank has brought to them. Thank you, John, and we'll spend some more. Jeff.
Hi, I'm Jeff Lee. I'm the president of NewPoint Real Estate Capital. We're a newly formed, rebuilt agency lender that does Fannie, Freddie, and FHA, and we're building other products for you guys too.
So Jeff is really humble. We also have a 25-year relationship. Jeff was one of the senior credit officers at Fannie Mae. We then launched together a Fannie Freddie company called Beach Street Capital, ultimately became Capital One. I want to welcome my Capital One friends. Jeff ran that group for many years and now is the president of NewPoint, which is a Meridian-sponsored agency lender led by David Brickman, who's a CEO, who's a former CEO of Freddie Mac, and Jeff is president, and we're really, really excited. And in the first 6 months of inception, we will do almost $2 billion worth of business. So thank you, Jeff. Scott.
Good morning, I'm Scott Waynebern. I'm president of Limekiln Real Estate and co-managing member of MF1. We're the leading alternative provider of debt to the multifamily markets. I was in the 7 a.m. spinning class. I didn't see Ralph. I can't find anybody who saw him in the 6 a.m. either, so.
Thank you. Well, I am jet lagged from coming back from Israel and celebrating the birth of a grandson, so thank you.
Even better.
Thank you. Scott's a great guy, and Scott, we know you as MF1. What does Limekiln mean? We don't even understand where that name came from, so why don't you just share that?
If you can't think of anything, you take the road that went by our house, but it was actually Limekiln Pike, which was commissioned by William Penn in 1655 as the road into the wilderness. It took the ground that I grew up on and turned it into bricks and mortar, and it was the road that went down to downtown Philadelphia and the ports and some of the first buildings in America. Some of the first bricks of the New World came from the soil where I grew up, and the buildings, including Independence Hall, that stand to this day. And the road stands for old buildings, longevity, Philly grit. That's what Limekiln means.
Okay, so now we know.
Don't ask me what ACORE means then.
We're going to ask you. But anyway, we refer to you as MF1, great lenders, and we'll spend some more time. Joe.
Hi, I'm Joe Fingerman. I run the commercial real estate efforts at Signature Bank. It's not that exciting of a story. We don't have any, going into the wilderness names, that go through. It's just a bank. We're headquartered in New York, $100 billion bank, a startup, and strong presence in multifamily, retail, office, industrial in the New York metro area. And it's good to see so many of our borrowers, friends, and be back together with you all at eCore.
And Joe is also humble, great guy. We know each other for many years. And Signature, which is one of the largest New York City-based bank, became a huge cryptocurrency bank. The stock has gone through the roof. But the good news is they are starting to slowly expand international markets for select clients. So we welcome you to that wilderness.
Has Joe ever worn socks before? Do you know?
We're doing pretty well.
It's Florida.
Tony, what does ACORE stand for?
eCore was
It actually stands for Alpha Commercial Real Estate. It has nothing to do with the wilderness. And that's all I'm going to say. I'm Tony Fineman. I co-head originations for ACORE Capital. We are a non-bank. We've been around for about 6.5 years. Over that 6.5 years, we've lent about $28 billion, all asset classes. And we'll find out more as we go along. And Ralph, I don't think you needed to spin. I think you look great the way you are.
Thank you. Appreciate that. So in setting up this panel, we decided everyone knows about Meridian, but let me just give you a little plug. We will do in excess of $50 billion of business this year. We close an average of, we do around 4,000 loans a year. So if you think about that, with working 6 days a week and closings 5, that's way over 10 closings a day. And it's all done with a variety of lenders, and that's what makes it so unique about us. And I really, every single one of you are personal friends, but what we decided to do is to take some really important data points, because everyone over here knows you're all here because you're all in real estate, you want to get into real estate, primarily multifamily. Out of $50 billion, over 50% of it is multifamily. But what we have is some really interesting slides that will have some good educational points that when I was going through them, actually, we know these things, but seeing them on slides, you can really learn from them. So I'd like to share the first slide, which is really interesting. So since the beginning of COVID, I've been a big believer that the calls for permanent workplace, work from home or everything else is not going to just stay. So if we look at this, if we really look at this chart, you see how during COVID, we all know what happened. The workforce went dramatically to working remote. We are now getting back to close to where we literally see this within 20% of pre-pandemic, some numbers. I know, Tony, I saw you make that. I had the same questions when I saw these charts, but they're national. So while we're coming from New York, New Jersey, and certain major cities, and we look at our office buildings, we see only 20% of people showing up. But we're going to use all these are thought out, well-researched data points that I think for the purpose of this conversation, we can debate it, we can challenge it, and I will show you which ones I've challenged. But I think it's really an interesting dynamic, and this is done by Google, so we all know that Google tracks everything that we do, so they track us when we're going to work, we track us when we're going home. So it's actually a pretty interesting thing, a pretty interesting chart, and I'd like to ask you, John, you sit at the epicenter of the gateway city multifamily lending. we talk on a daily basis. We've seen New York City go, from 30% vacancy factors to what it is. You're now a national lender, and you have so many of your clients here that are national borrowers, okay? What is you as an individual and as a lending institution thinking about the work from home phenomenon and people getting back to work, but also what is it causing to the multifamily space?
So obviously, people working from home, they want a good place to live, especially if they're going to be working remote. I don't see remote changing anytime soon. I know as a manager, I would love to have everyone back in the office. It's not going to happen. We have looked to hire people, and one of the first questions they ask is, what's your hybrid schedule? It's not even a matter of when you're going to go back full time. So I think hybrid is something that we're going to be living with from now on. And what's that going to do? It's going to put more pressure on good multifamily housing. It's going to be an opportunity for us on this panel as well as others. I think it's a great opportunity for owners. I think that where rents are going is just an indication of people wanting to work from home, and they don't care what it's going to take money-wise and rent-wise. They are going to work from home, and they will do whatever it takes to live in a good area, in a good neighborhood, and hopefully they can continue to work remotely. I don't like it, but it's just something that we're going to have
So
to do.
I was talking to the CEO of a bank, and he said to me, we're 90% operational, 40% functional. And I think the fact that everyone has come out to this conference, I'm a big believer that the working from home will not sustain through the next few years. I think maybe, Fridays and other days of the week. But we are seeing actually in New York City some major transactions that have just happened, and we're seeing good leasing activity. So I'm actually, let me make it very clear. As CEO of a company, I really don't like it. I think we have 95% of our people back. But it's definitely a trend. And Jeff, you sit at the epicenter of also multifamily, at the agency for so many years, at a bank, Capital One that was so data-driven, and now at NewPoint. Where are you seeing these trends, and what is it doing to the multifamily? And just share with us some of your thoughts.
Well, I mean, from a data perspective, it's interesting, but like I live in DC, and I don't know about you, but I mean, the traffic in DC is horrendous again. It feels worse than pre-COVID, so I'm not sure with all the data that says there was migration out, I'm not sure where they all still seem to be there. And if they're not going back to work because the offices aren't full, which I don't think they are, I don't know where everyone's going. But if you look at this chart here, I think Dallas is the only city that actually has rents above pre-COVID. I think most of the other cities are actually still, while it's year-over-year rent growth, it's still below pre-COVID. So I think everyone's still watching that from a credit perspective. And then, the economy pumped like $6 trillion of, subsidy into cash, right, into people's pockets. And they think there's a lot of cash sitting out there. And I think everyone's trying to figure out what happens when that cash sort of burns out or is spent, and then from a credit perspective. And then, how permanent is a lot of this migration? A lot of people, like the next generation, isn't going back to the office. We're trying to hire at NewPoint. We've hired 50 people, and probably 25 to 30 of them said, hey, I'm not going to take the job unless, you let me work remote. And I've moved to Nashville or wherever, or a low-income tax state or Florida. So I think there's a change.
Thank you. Scott, MF1, Limekiln, you are a balance sheet lender that does a tremendous amount of multifamily. If you could share some numbers with us and also give us your perspective of this, and then we'll move on to the next chart.
We're looking at rent rolls from all over the country every day. So there's a couple things that aren't dimensioned up there. So one, non-gateway cities. What's going on is insane. So we do a lot of value-add lending. We're seeing we do a lot.
You're stealing my third question, but that's okay.
Okay. But just...
Let's go with it. It's fine.
Okay. We're seeing people that bought some of the grittier properties in Phoenix that we've lent on, not do the renovations and getting 25% year-on-year rent growth. If you do the math, over the last 7 years, they've created basically 50% of the units needed to house the migration into Phoenix. And at the same time, our other top 4 markets are all key markets: New York, Washington, Philly, San Francisco. And what we saw was breathtaking from, say, May to August. We're talking about, the higher end properties where people with disposable income who aren't afraid of skipping on their rent left They all came back, whether they went back to the office or not. We're talking about 15, 20, 25 points of occupancy gains in 90 or 100 days. I don't think anybody will ever see anything like that again. That's San Francisco, it's New York, and so the tailwind, I think, is better than we've seen up there. Both anecdotally and what we're seeing on rent rolls is rents are above pre-COVID levels in the gateway cities now, with the exception of a couple of overbuilt markets in Los Angeles.
Thank you. We're going to go to the next chart, which is actually pretty interesting. So there will be close to $250 billion in apartment sales in 2021. The market as a finance market is $450 billion a year. But over $250 billion will be the amount of sales this year. Fascinating chart. It's up 25% from 2019 pre-COVID, okay? We all understand that we're undersupplied, like everyone said over here. The cost of construction are just tremendously through the roof. Tony, ACORE has been among the most active funds financing the acquisition boom. What does this chart look like next year at eCore? And you told me not to ask you any hard questions. This is just...
Fifth inning.
I'm sorry?
Fifth inning. Oh, sorry.
And one of the fundamentals you're seeing also in this marketplace. So talk about your lending criteria, how you're deciding, you're also lending on new construction. So share with us some of your thoughts, and let's talk about this chart a little bit.
So, I mean, I think the chart's interesting, but I think maybe, you know, we talked about this the other day, what's behind the chart. Those sales are not made up of a tremendous amount of volume in Manhattan, right, in New York City, which is what it's been historically. So there's a lot of liquidity in the market today. And I think that there's a lot of liquidity on the sidelines that have been sitting around not knowing what to do. So first of all, the 2020 sales didn't happen, so there's some 2021 sales that are 2020 sales that didn't happen. It's just, I don't know, I think it's going to be very interesting. I think all the stuff that we're talking about is, it's going to cause underwriting to change throughout over the next couple of years. So Manhattan's very busy right now, but every office owner you talk to says that it's 20% occupied today, right? So why is Manhattan so busy, and how is that going to end up how's that going to end up affecting our underwriting? So when you ask us, you said, you know, how we're doing a decent amount of construction throughout the country, but most of the construction that we're doing is in these secondary and tertiary markets where at least there's a perception that people are moving, like Florida, Nashville, Atlanta, you know, Phoenix, places like that.
So Joe, you're sitting in New York City with a huge portfolio of multifamily, performing extremely well. You're also an active new lender on new acquisitions in New York City. So to you've seen the market go from its all-time high to COVID. Why don't we focus on New York City? Because so many of us are from families that are born in New York City. And, you know, I recently met someone from the Midwest, and he said to me, it's amazing. I'm selling everything in the Midwest and coming to New York, and everyone from New York is coming to the Midwest and buying. And I said, that's really what's making the market. And we have some really interesting charts about supply and demand and what's being selling. But Joe, why don't you share with us Signature's philosophy in New York City and how you're lending? And
So Signature's a New York-based bank. We've always been bullish on New York. I think every one of us that are sitting up here today, you know, in the dearth of COVID of March 2020, would sign up for the point we are at today as far as where the market has recovered on multifamily. We have seen almost a V-shaped recovery on the multifamily releasing market. There are some free market units that were rented, you know, at the very, you know, bottom of the market that are now rolling. But in overall, we're seeing strong performance on the multifamily sector. The bigger issue in New York, and I think it's also more nationally, and it might have changed the other day with the election, is the political nature in New York, because that's a big part of the business. Every time we seem to find, you know, someone that we think is liberal, we find someone that's even more liberal, and you know, that's difficult for us to underwrite into the portfolio. But in general, you know, we're very bullish on New York. People want to live there. You know, my office is based on Long Island in Melville. It's hard to attract talent of young people that want to live in Melville or reverse commute. I'm sure John has the same problem in Hicksville, you know, both Long Island markets. Everyone wants to be in Manhattan, everyone wants to be in the boroughs, and we're seeing strong occupancy throughout the portfolio. We're also seeing a lot of sales recently. I don't know if they're capital gains driven or, end of the year tax planning, but there's been some decent transactions that we've seen going on.
But those sales, in my mind, are driven by a pent-up demand, right? People saw their assets drop in value significantly on paper, right? And the second the second that the leasing started, there was an opportunity to sell again, they went and sold. But my personal opinion is that Manhattan was never going to go to zero, right? I mean, in April of 2020, no one was ever going to live in Manhattan again. Everyone was moving to Florida, and no one was going to ever come back, right? That obviously was not going to be the case. The question is, what does it come back to, and how do you? I mean, the good thing for all of us on this stage is that we lend, 55%, 75% of some very smart buyer's bet, right? So we have a lot of room for a mistake. You're laughing at the bar.
No, I'm just,
They're all in the room. So they're all in the room. So I'm saying that they're very smart.
All my bars are now annoyed at 55.
But the point is, exactly. But you only lend 50. But really the point is, I mean, there's a reason to be optimistic because it didn't go to the levels at which maybe some people predicted. But I also I'm not 100% sure that we're going to be back to the level that we all want it to be, because the bottom line is you are having a hard time hiring people today, right? People don't necessarily. Of course there are people that want to live in Manhattan, but there's people that want to live in Nashville still. They're those same people that are working for Jeff that don't want to live in Manhattan. They're not renting an apartment in Manhattan. They're renting an apartment in Nashville. So it's gonna put pressure on rents as things settle out. I think there's optimism because of the V-shaped recovery, but how far it goes to me is still a question.
As a business owner in Manhattan, I think I have a little different perspective because you're in DC, you guys are in the suburbs. Some people left town when COVID hit. The people who stayed in town were doing Zoom at home with their roommate or significant other. And that lasted about 3 weeks before, they wanted to murder each other. They came to the office as a respite. And so, we share a floor with the owners of the building. So
is everyone back in your office? Is everyone back in your office?
We're rationing space.
Right, so I
just want to make the point, though. I think Manhattan and the value proposition of living in a big city, going to a Rangers game, going out to a bar, meeting your future wife, whatever it is you're going to do when you're interacting, walking into a bar, we're on Park Avenue. That's what's different about Manhattan. That's why we leaned into COVID in these markets. And I think it's not saying my company work environment's any better than yours, but the physical location makes a huge difference in that Manhattan is fully back except for people going to work.
I don't think that's true. Manhattan's not fully back. That's not right. I mean, Manhattan's very busy, but it's not fully back. And the problem.
Were you walking around Manhattan at 11 o'clock last Friday night and seeing?
So one second, hold on.
Guys. Manhattan is not.
All right, it's getting exciting over here, but let's just say.
Let me just say one thing.
All right.
I'm not saying that Manhattan's not coming back. What I'm saying is to make a statement that Manhattan is fully back, it's not accurate. There are people that left and are not coming back.
So I think there's a couple things going on. There's New York multifamily owners that are suddenly using a term my 15-year-old uses, FOMO. They feel like if you're missing out, they feel
that's true.
This is I always wanted to buy a building on Park Avenue at this cap rate, whatever that cap rate may be. I'm jumping in now because it will come back. Secondly, for the work from home situation, it seems like most of the workforce has no problem going out for dinner, 11 o'clock Friday night, going to a Ranger game, things like that. But I can't go to the office, right? So you see all these.
I have a question. Do you think?
Joe, I agree with you.
But wait,
back to
here's my question. Here's my question.
Until the owners say, get your butt in your seat.
And if you force them, they quit. So you're stuck in this.
Someone's going to offer them a job where they get to work from home. So it's not everybody. Here's my only point. If those of us that sit here and pretend that there hasn't been significant change that is permanent are I think gonna make some mistakes. That's all.
So young people who don't want to come here and shake everybody's hands are going to be very sorry 10 or 20 years from now.
I only saw one mask in the room, so we're doing, and it was a Meridian guy. So let's.
And he left.
I live in Florida. I don't even know what COVID is. So, but
I just want to say, I think everyone is right. We're at One Battery downtown. Meridian is 99% back. We've been back almost since June of last year when everything was allowed. But our building that has 1 million square feet, I think when I walk in every morning, I used to say how many people at the building. So when we came back, I actually went to Brooklyn to find a loft space with outdoors. We were going to have a lot of fun. And then I came to the office and I said, I just found it. It's my own building. There was no one else there. I don't believe our building has more than 30%. I recently went to see the chairman of one of the major law firms in New York City. I walked through the law firm, it was empty. We walked to his office, literally, there was no one there. He told me we're having our best year ever. We're working, we're saving in travel and entertainment. People are putting in more time. So I think New York City is back, that their restaurants are full and the apartments are full in the streets. I believe the workforce, but I believe that will change dramatically. There's been some major transactions happening in New York City on the office side, and I think people really do believe that they do not want to go back to, that people don't want to work from home. You mentioned about the millennials. I was having this debate once with one of my colleagues, and he said to me, he says, Ralph, if you're working at Meridian, you have 4 kids at home, and your wife is nagging, you want to go to work, right? If you're 28 years old and you're at home with yourself or your significant other, you are very happy. And what that's done, that has made anyone that's living in a building literally go from a 1-bedroom to a 2-bedroom, so they have a private workplace. I think we can debate this. The question was, what does eCore look like next year? And I think that will be...
Yeah, and by the way, don't take what I think there's tremendous amount of opportunity over the course of the next several years, and I think, frankly, it's more exciting than it's been I've been doing this for 30 plus years. It's more exciting than it's ever been because we used to just look at the past and predict the future, and I think there's just been a lot of change. Like, even the change that you just said, right? I mean, you mentioned 10 minutes ago about the fact that maybe people won't work on Fridays, right? That's 20% of the week.
They're going to work from home.
No, that's what I meant. But that's 20%. But that's 20% of the work week, right? And so there's a difference in utilization. It's just how we underwrite is changing. And my only point is that to act as if we're going to go back to exactly what it looked like before, I think is false.
So I was actually in John's office. I want to give John credit. For many years, I would call him at 3 o'clock on a Friday and say, Ralph, candlelighting is 4:16, go home, right? So if we look at the New York Times, they always put candlelighting for many years. But I was actually in his office during COVID, and we looked at his office, and he said, look at that parking lot. That is the parking of the train to New York City, and it was empty. That was 6 months ago. I was there 2 weeks ago. It's full again.
It's not the way it was, but it definitely is better than it was during COVID. You're absolutely right. And we talk about Manhattan, it's so crowded because no one's taking public transportation. Everyone's afraid to get on a subway, they're afraid to get on a bus, whether because of safety reasons or getting sick.
I defer. I ask people in the office that take public transportation, what's it like? And they tell me it's filling up again and it's immaculately clean. So I think New York City has a huge opportunity, but we have multifamily people in this room that are looking across the country, so we should try to focus on that. This next chart is really interesting, and I think this is probably the most important chart we should debate in this room, because everyone in this room is either a buyer or a seller. So you look at this really, what this determines is apartment buy, hold, sell recommendations. And this is a ULI study. It's pretty accurate and it's well thought out. So the bottom blue says the percentage of people will say it's a good time to buy. The gray is what says hold, okay? And then the other one, the top smallest portion is the one that says sell. So I think I'd love to open this up to the room, but I'm not allowed to do that. But we have some really smart people in this room. We have my good friend Jordan Sloan, we have Lamar Morale, we have some really major owners of real estate in the business. And I think everyone over here is a buyer and a seller. So, by the way, just for pure disclosure, I challenge this chart really well. And if someone in the audience wants to really give an opinion, I'm going to go off the panel and ask them to do this. Because this is basically showing that a big percentage is saying hold, another one is saying, buy, and a small part is saying sell. So if that's the case, I once hired a consultant at Meridian, and the guy came in and he said to me, he said, it's amazing, you have a 93% client retention at Meridian. And I said, okay, I fired him, and I said, that means when I go to a wedding and I meet a guy not using Meridian, that's all the 7%, that can't be possible, right? The bottom line is, this is really, to me, and I don't know how accurate it is, but let's just assume that it is. So you're seeing that a huge portion of the industry is saying, let's just hold, right? Another huge portion is saying, a small portion is saying to sell. So what's really happening? So when I look at this, and I'd love to hear from anyone in the audience if they want to step up and say something, or someone over here, is what's really happening in the market? Is it the compression of cap rates, and we'll get to all that, that people, the same people that are buying are also selling, right? One of the most active buyers in the industry are, selling because they have investors, they want to return some capital. So gentlemen, why don't we just have a very free forum about this and ask, what are you seeing as far as this tremendous acquisition volume? We saw the numbers, but this chart is telling you how certain people are just saying hold, certain people, and a small percentage is saying sell. What are your theories, Joe?
So I think for New York, when the June 2019 rent laws changed, we expected to see a huge amount of families sell, and we have yet to see that, and we haven't seen that through COVID. We've seen some exit. We've seen some funds, they're going to sell immediately. They just can't do this anymore. And we have not seen that many payoffs. That's usually an indication for us, or refinance, or new loan requests for sale. So I don't believe that's happening in the New York metro area. I don't know, if the Meridian investment guys are seeing something different, but I don't see a huge amount of volume where people are like, I give up.
I'm definitely not seeing the volume of sales, especially in Manhattan.
I think
To me, it's very, very slow.
Yeah, the better the market and the better the property, kind of the more depressed it was going into COVID, because that was where things were overbuilt and maybe the rent targets were too high. So I think people aren't willing to sell. They can't hit their numbers. And in the Sun Belt, it's the opposite. And I wouldn't always confuse the buy, sell, hold for where they think the value is going to go up. Some people are, quick IRR driven. They have an LP that they need to sell. They're going to crystallize, but promote. Take the money, 1031, and buy the property next door. And so, Phoenix, for example, has tremendous transaction volume. Dallas, the same thing. And then there's also, Rip Van Winkle wakes up and says, I can't believe my property is worth 4x what I paid for it in 2013. Yeah, I'm a seller.
To me, what would be more interesting in that chart is to see what it looked like historically. I don't think anybody would argue that transaction volume this year is the biggest it's been in 10 years, right? I mean, and a lot of it is acquisition volume. So clearly, anyone that's telling anyone that is telling you these sellers to hold, or they're not listening, because there's a ton of activity out there. So, I don't know if that would be consistent historically, the opinion of whether you should buy, sell, or hold. But there's a lot of sales going on nationally. Obviously, places like New York, where maybe the perception of a return of equity hasn't gotten there yet. But across the country, as Scott said, I mean, the transaction volume is gigantic, and it's sales volume.
But it's interesting, a lot of the sales that are happening, and I'm sure everyone in this room has seen this, someone that bought a property 3 years ago and had a 5 or 7 year plan is hitting his numbers that much quicker. So if you're a syndicator, you're getting into promote and they're selling. Literally, right before COVID, someone showed me a deal and he told me he just sold it. It was a 5-year hold. He held it for 2.5 years and made a 3x because of the increase in the marketplace. And I think you're right. If we looked at this chart, it would look very different from a couple of years ago. But let's really debate, is this going to continue? And that gets into the cap rates and the underwriting and all the other stuff. So John, you sit at the bank that's going to be $100 billion soon, one of the leading multifamily lenders in the country. You guys debate this internally all the time. And what's your view of the future of multifamily? Let's just take 1 year on the sales side. What do you guys see?
First of all, where are all these people coming from? We've expanded now.
1 second, they're coming from to buy?
Not just to live. Where are these people
Where are the
coming
tenants coming from?
Where
How
are
many
these tenants
people are out
coming
there?
from? We're looking at 95% occupancies out of areas that we typically didn't lend in. I just want to.
You told me last night you looked at a property and you asked the owner what the occupancy, and he said 80% of rent collections. And he said, Ralph, you got to figure out what I'm doing over here. So not everything's 95% occupied.
No, okay, his collections was 20% off. His collections were. He was 95% occupied, but his collections were definitely not what I expected to hear, but that's a different story. It does boggle my mind that some of these markets in gateway cities or outside of gateway cities, that people are moving there. But where are all these people coming? They're coming from somewhere. Are they just relocating, and are they leaving a void somewhere else?
They're all coming from Europe.
It must be. It must be. Either that or
huge influx from Russia, guys.
Well, there's also some path down, I think, at the Mexico border that you can kind of get in. But besides that, it boggles my mind because I just don't know where these people are coming from. That said, we make sure that we know who we're lending to, because that is, half the battle is having a good sponsorship. And if you don't trust or have that good feeling about who is, signing on the dotted line, then you shouldn't be in business. You got to make sure, as far as I'm concerned, you know who you're dealing with. Make sure that you do your homework on the economics in the area that you're lending in, and just hope that the economy stays strong. But I'm just afraid that this is a bubble that's going to burst.
Jeff?
I read a bunch of articles. I think there's a theory that there was a lot of people that pulled that retirement age that retired early and pulled cash out of their homes and moved into apartments. I don't know, you have a lot of borrowers here. I don't know how true that is. Someone at work thinks that there are a lot of people living in their parents' basements and have moved out, can now afford to live in an apartment. I think everyone's balance sheet has gone up in the country. I think if you look at the data, cap rate spreads are still pretty wide relative to history. There's still a little bit more room to go, even if Treasury moves up. So I think acquisition activity keeps going, and there's enough cash sloshing around the market.
Right, so I can tell you just from talking to people all the time, they say, Ralph, my kids gave up their apartment, they graduated college, they didn't find an apartment. You got to remember, people that graduated college and were working from home, and my wife is telling me, find them apartments. They go to Brooklyn over the weekend, they look at an apartment, we heard this from your CEO, and he said, they wait till Monday and that apartment is gone. So I can tell you that David Brickman, who's now the CEO of NewPoint, who's, an MIT graduate, very data-driven, really has, and we've had meetings with some of the largest banks in the country, and his data points really do demonstrate that there is a shortage in apartments for many, many different, in many markets. So we'll talk about gateway cities, we'll talk about, secondary cities, we'll talk about tertiary markets, because I think they've all changed dramatically throughout everything. But I actually, you say where they're coming from. I think there's reality. I can tell you that during COVID, we closed a large loan, and the borrower kept on telling us that they were renting 8 apartments a week. Jeff, was a building that you and I inspected right before COVID. And it got to the point that I was questioning the validity of that, and we actually closed a loan, and he was able to substantiate. It was a high-rise, brand-new building built in Brooklyn, and during COVID, he was leasing 8 apartments a month. He was giving, 2 to 3 month concessions, but that slowed down too. So I actually, believe it or not, I live in Brooklyn, I drive through and I take pictures of buildings and I send them to my research. And you see the rent growth. There's a new phenomenon in the market. Abe and I were talking about this morning. Every apartment's worth $400 more than it was renting for. It's not even a percentage. It's just a huge number. Everyone says I'm getting $400 more than I did. But I think there is, and I'd love to hear what Scott, you guys are pretty methodical, raised a tremendous amount of capital. I mean, what are you seeing as far as supply and demand in the rental market? And are you worried about that?
The next 12 months, have probably never been set up to be better for multifamily. So, supply wave was heavy going into COVID. COVID and building costs and supply chain issues means we pretty light supply hit for the next 12 months. Now, all this positive news might mean 24 months, 36 months, the supply may come back. But for the next 12 months, it's probably about as good as it's ever looked. And the embedded gains in the rent rolls, the loss to lease from people, turnover's like the lowest it's ever been. There's been these big rent gains. And so I think the odds of NOI being higher in almost any multifamily property 12 months from today are the highest they've ever been. Incredible tailwind in rate movement in the Sun Belt and in the core markets. First you saw occupancy go away, then you saw concessions go away. The LROs aren't working. People are going old school. We're going to raise rents $100 or $200, $400 this month and see what happens. And when they do that, the apartment's still going on Monday. So okay, let's do it again next month. And all the people that are sitting there with those old rents, the COVID discounts, I got 20% COVID discount on my rent. I went to renew, they said 5% over your old COVID rent. I said, can I have it for 2 years? And I signed it the next day. It's the tailwind's incredible.
Your own apartment? That's you yourself?
Yeah, the renter, yeah.
Wow. During COVID, you didn't buy a condo? Those depressed prices?
In this political environment you're talking about in New York, I think you're asking for trouble in Manhattan.
I'm sure your landlord's kicking himself for letting you sign a 2-year lease, too.
Yeah.
All right, we'll get the address later. We'll make sure if we're working in
Yeah,
that
Ralph,
market.
send us the deal.
Anyway, this is actually a pretty interesting chart now. Do this next chart. So the ratio of residential units under construction to residential buildings. Everyone's building, there's a shortage of builders, and does it pay to build today? You guys are lending, some of you are lending into construction. John, you've done a few recently with us. Fannie Freddie has some lease-up programs, stuff coming out of construction. Tony, you're an active lender in construction. What are you seeing, and are you concerned about the cost of construction and overruns, and how do you value that?
Yeah, I mean, I think. On? Can you hear me? No. That chart, that chart's interesting. I definitely think that construction projects, the volume of construction projects we're seeing has trailed off in the last few months. And I think the main reason is just what we're talking about is labor shortage and supply chain issues. The cost is going up tremendously, and the numbers don't work as well. So throughout COVID, we lent a ton of money on construction and saw more projects than we had seen in the 6.5 years we've been in business. But I would say that it's trailed off, and it's trailed as a result of that. And I think, to Scott's point, there will be less supply coming in the market over the course of the next 12 months because I just don't think there'll be as much construction. You're still going to see it. I'm not, but I think it's down. And we're much more cautious than we've ever been as a result of the cost dynamic. I mean, it's impossible for these projects the numbers just don't work because of the labor costs and the cost of goods, the cost of materials.
So on a construction loan today, I'm sorry,
Yeah.
1 second. What leverage point will you go to?
I mean.
85,
At your
90.
party last night, I told everybody 90% so they would leave me alone.
2.5% on the rate.
Typically, we're in the 65 to 75% of cost range. And, we maybe for the right sponsorship will go higher. Maybe with a little bit of recourse we'll go higher. But it's very sponsor driven and very, very specific to the project and the market.
Scott, you seem like
I think this is a magic chart, and if you look at it, over the long term, it's kind of on trend, even though it looks like a big V. And so, if you go look at the boom of the last cycle, the 2000s, look at the drop in units. So we're still at a hangover from the lack of production, especially of rental units. Some of that was the single-family mania. So we're still feeling the benefits of that lack of investment. The other thing that you don't see is it's not a net number. Apartments disappear, right? They go from B to C to D to getting plowed under or being unlivable. And so you're actually losing units throughout that. And there wasn't the big value add business like we're supporting right now that's keeping some of that C stuff and upgrading it to B instead of having it disappear. So it's actually the supply, it's more positive, kind of supply demand than even that chart implies.
That's great. All right, this is really the crux of the multifamily lending chart. We're going to try to get some real good dialogue and debate on this because we have a variety of lenders here. If I can get the next chart. Okay, so what we have over here is multifamily lending, which we know is around $450 billion on an average. We went through the sales side, $250 billion. So, Jeff, I'm going to start with you. The agencies, Fannie, Freddie, and HUD is around $150, $170 billion a year. Great long-term financing. Why don't you share with us where you see, the strengths of the agencies and where you see them going? And the real question is, that means the agencies have not grown over the last few years. So there's a huge void which is getting picked up by everyone. And my real question to everyone so they can think about it is, where is your biggest strength in lending? But we'll start with you, Jeff, on the agency platform that you've been doing your whole life.
Yeah, so I've been doing the Fannie Freddie stuff for more than 25 years now, and I think, when you think about that product, and for most of the owners in here and brokers who are good financial advisors, like it's a long game with the agencies, right? And so ultimately, while sometimes it's a sexy product and sometimes it's not, right now it's still cheap money. I think we still offer a competitive IO. It's still long term, and while sometimes you might need something more, I think everyone really does have to think about the long game and remembering that The agencies were 60% market share, 50 this year. They're going to be 40 at 150 billion against maybe 400 billion of debt originations. But in a crisis, when things shut down, they go back from 40 to 90 in a heartbeat, right? And it's important for all of you guys to know that they all remember who their borrowers are, and that they have a track record with their borrowers. And I think it's important to diversify. I think it's important to make sure that you have, the Fannie, the Freddie, and have your sort of feet in both. And because I think one day, while you may not do deals with them for 3 or 4 years, when the crisis does happen and you guys are looking for that, I think that's when you're going to want that relationship with Meridian, of course.
Well, it's interesting because I've spent some time with some of the heads of multifamily lending at Fannie and Freddie, and one compliment I really gave them with 100% sincerity was, during COVID, they 100% supported the market. On one side, they offered forbearance, but on the other side, they were actively lending. And the banks didn't do that. New York Community Bank was an exception. They lent right through COVID. But there were
the only ones.
There were other banks. Jeff was at Capital One then, and we had I will compliment them, we had $400 million of multifamily New York City deals in the pipeline, and we actually closed almost every single one of them. I'm not going to say that there weren't reserves and everything else. But one thing, Jeff, you said it, the agencies, long-term lenders, interest rates are low, and they were there. But Joe was there. Joe was there.
Just want to make sure.
Joe was there.
Question over in the big situation over here.
But Joe, you were there, but a lot of stuff was not getting done in New York during that time. I will tell you, we closed a loan with an agency lender right through. 1 second, Joe. I'm coming back to you. It's going to end well. Don't worry.
I hope.
It's going to end well. We closed a loan. A foreign family bought an acquisition. We actually, Meridian Investment Sales, sold it. Really smart family. They came in and they got an interest rate that was 2.5% for 10 years from an agency lender, and they believe that made the deal. I had lunch with them recently. They said, and this goes back to the early conversation, they said, with all our London School of Economics education, we did not model in the rent growth that we had. So the deal went from X to Y. This was a fascinating play. They said we were just betting on interest rates, because if interest rates went up over the next 10 years, 200 basis points, just the return because of that created a tremendous value for the asset. And I still don't understand what they meant, but one thing was good, rents really did go up in this Manhattan building. But John, I'm going to go back to Joe, because Joe looks like he thinks I didn't give him the right credit. There's no question Signature Bank was another bank that right through COVID, we had major clients that were buying and saw great opportunity, and the bank lent their money to that. How did you do that in the same environment when you had so many people coming in asking for forbearance, and what's your feeling on just going forward?
Well, first of all, I think, what John said earlier, really knowing your borrower. A lot of, most of our borrowers, so the deep relationships knew us. I'm not going to say we had 1 or 2 come up lame, but otherwise they did well. But, it's hard for our staff. We have some staff people out here, we're almost like closers in baseball, like Mariano Rivera, like he blows the game the night before. So you could have one phone call where the guy's like, my collections are 60%, I can't get these leased. And then the next phone call is, Carrie Pollock at Meridian saying, I got this new multifamily on the same block. It's great. It's 100% occupied, 100% leased. Everyone's paying, and you've got to bounce back and understand that, not every deal is, each thing has to be looked at differently. But, I think to both of the bank's credits up here, near Community and Signature, we both worked with our clients. We both stayed in the market. We did have banks in the New York metro area, we're not going to name who just said we're not lending right now. We're selling the portfolios. We're, winding them down, whatever it might be. And, we continued with the model of, we have borrowers right now on forbearance because they're having problems in certain different pockets in Manhattan that we're making new loans to in other locations. So that says a lot about, the strength of our relationships and our belief in the market.
So John, you're one of the most active multifamily lenders again, and then you compete with the agencies, but that's $150 billion cap, so it's $450. As a lender, you have demonstrated that you follow your clients across the country and have been doing a tremendous amount of business nationally now. Share with us your thoughts, how you see, your lending practices and how you're winning over some of the agencies, because I think it's important for the crowd to hear.
I think it's important that you as a borrower have someone to pick up the phone and talk to. I'm not saying you can't do that with the agencies. It's just not the same as dealing with Joe or myself when we close a loan and putting it on
Or me or Scott.
Sorry. I'm sorry?
I just said or me or Scott. I just didn't want you to keep this out.
As far as people wanting to know that certainty of execution, for one thing, and we could have our issues with processing sometimes, right, Danny? Right? But once we get through that little nuance, people know that with a bank, especially like us, that you sign up the deal, you're going to close. We can negotiate loan documents. I mean, we don't love it, but a lot of the agencies and some of the other lenders, it's you get your agreement, take it or leave it. That's usually not the case with portfolio lenders like us. We're long-term, we're generational by way of who we deal with. It's families, and they know New York Community Bank, they're going to get it done, and if they have a problem, they can pick up the phone and we'll be there. They're not calling somewhere across the country and speaking to someone who has no idea who they are or where the property is. I think there's a lot to be said. We might have to charge a little bit more just because we can't be as thin as the agencies, but I think we can compete with service and we can compete with dollars.
Thank you.
Couple things, kind of going back to COVID, I want to put out a little advertisement here. We couldn't get arrested in New York before COVID happened. We had no balance. We felt it was an overlent market. We didn't like the way things worked. Pretty clear, very public what happened to a lot of our peers who were publicly listed. We were strong. We said this is an incredible opportunity. We raised money into COVID. Meridian showed up and said, now's your time, and brought us important deals, in Harlem, further up in Harlem, out in Brooklyn, and during the summer of COVID in 2020, we closed those deals, and it kind of was transformational for our business. And we wouldn't have done that if Meridian, hadn't brought us those deals. Drew Anderman, Morris Patesh, and that was pretty incredible. And now we've done, on our scale, $1.3 billion in New York in 15 months is pretty incredible, and that's kind of helped us grow everywhere else. I think the key to that slide, and I think today we were talking about, got to remember me and Tony here, the real growth in the market's the debt funds. The banks, I don't know if they've been static or they've been shrinking portfolios. I mean, I think your regulators are nuts. They used to be on you for having too much multifamily, right? They should have been saying, I don't know about the other stuff. New York multifamily, don't worry about it, but they were on you. The growth is in the debt funds, and we've got unbelievable access to capital. When I say we, the debt funds, especially the private debt funds right now, if you can put the money out and provide a reasonable return and return their capital, it's kind of the bullseye of the bullseyes being a bridge lender for multifamily right now. So what I think's happened, I'm curious if you agree, Jeff, it's not really the caps at the agencies, but it's the specialty programs disappearing. The lease-up program at Freddie, the value-add fund at Freddie, and some of that other stuff. And certainly under Sandra, I don't see a lot of that coming. And so we're built to be complementary to the agencies. They bridge the agencies, and the strike zone, more than the volume, has shrunk at the agencies, and I think the debt funds have stepped in, and then also just the cap rates where people are buying with this rent trajectory kind of fits a bridge loan and a higher risk appetite more than a bank or an agency at the moment.
Right here it says 8 minutes and 18 seconds.
Yeah, I can't tell if Ralph's.
Is that right? Someone's telling me we have less time? We have 1 minute? All right, so how does it say 8 minutes and 8 seconds and 7
I think
seconds?
we should go by that.
All right.
Every time you say it is, right?
It's a Meridian clock.
That must be Meridian's technology.
Yeah,
clock.
right.
All right, so we've covered a lot of stuff. We had 2 more slides. We're going to skip one. We're going to go to the last one because I think this really is one of the charts I don't believe is as accurate, and that's about saying that underwriting, is this the one? No, let's go to the next. We all know what cap rates, we all know that cap rates have compressed dramatically, and we all understand why. But this basically, and I'd love to hear, what you think. I can tell you, Joe and Tony, this basically showing that underwriting standards have not changed over the last 5 years. As an intermediary, our job is to provide the best financing for our clients. we're actually seeing, and no one on this panel, that we're seeing a loosening of some standards. And, you know, we have debates internally in the office. I think one of Meridian's successes that our lenders know that we care for them and we don't ever want to give them a loan that they can have aggravation for. I can tell you that lenders are coming into the marketplace, and I tell my brokers all the time, if you don't control a deal, there can always be that one lender that will, you know, show up and give a little bit better terms. They might change it. I met a guy at the conference this morning, and he said to me, we're not using you on this deal, and we are closing, but we got retraded at the last minute, and we had no choice. We had to use the sales broker, but we 100% got retraded, and we knew exactly that going into this thing, you know, this would happen. It was a really, you know, we all talk about tertiary markets, which was another discussion, but there are also tertiary lenders, guys. None of these guys on this, you know, they might be here at the conference and they're great, but you need to just understand if someone's lending you X percentage, you know, and then laying it off through some different sources, someone's going to look at this file and say, okay, how am I getting paid for the risk? But I think that I'd love to hear what you're seeing, you know, Scott, anyone, Joe, in
So I
underwriting.
think, you know, we continually in New York, and that you hit on it, Ralph. You know, the banks almost fly into JFK and then go right to Meridian, and they have a new program, and they must have turned off my mic. I don't know. Sorry to that bank. You know, but it's a very big struggle, and I'm sure John has it too, where, you know, all these banks have liquidity right now. A lot of banks are sitting on cash, Signature is, and we don't want to make a mistake today just because we, you know, need to earn. You know, I always look at this business like, if you look at it from just a big macro thing, we take all this risk, I lend you 75% on your apartment building, the laws could change, it could burn, it could this, and I get 3%, right? It's sometimes a little crazy, like the pricing, and if you're a Jeff, it's like 2.5 for 10, but, or lower, but I'm just saying, you have to really be disciplined, at least, and that's what we try to do, is just not to make a mistake today that's going to hurt us 2, 3, 4 years from now, because we have a lot of liquidity. So I think that's where you may be seeing the underwriting standards change. Banks have to put out money, it's how they get paid.
Scott.
I think, you know, there's two cycles. Pre-COVID, it was kind of slowly every 6 months from the crisis, it was loosening. It really tightened, obviously, with COVID, whether it's reserves starting with the agencies and all of us, lower values, lower cash flows. I think in the last 6 months, and led by my brethren, it's loosened. I think some of our peers have made some mistakes, and they're kind of retrenching both their pricing, you know, and their structures. And I think, you know, don't get scared really until you go kind of past what you said. You got to know your borrower, and you want to have relationships and guys that, you know, do the right thing. We all learned a lot about our borrowers during COVID. And those are the guys that we're going to, you know, step up with. I think there's some new people running to multifamily. That's where maybe the seeds of the next bubble popping are, is the wrong people owning the wrong assets. But in general, it's a slow kind of classic credit creep, but it's nothing awful at the moment.
And the chart demonstrates that to a certain significant way. Tony?
Yeah, I told you this, because I don't actually believe that chart. I think that we've seen a dramatic decline in standards, and to me the standard that we're seeing a lot of deals where we're losing deals because our competitors, and it's not the banks obviously, it's other competitors in the non-bank space, are willing to underwrite to, you know, stabilize 5.5% debt yields as an example.
Let me ask you a question.
Construction loans?
And oh, I'm sorry.
So you're a borrower sitting in the room, and you say to yourself, okay, if they're loosening the standards and I can go now and get a higher percentage of my acquisition, I don't have to syndicate the deal, why shouldn't I do that?
They should do that. Yeah, I mean, I'm not saying that the borrower should take advantage of it, because once the lender lends you the money, you have the money.
So I don't actually.
But you asked specifically about that chart, and I think that chart may have been the lenders surveying themselves and saying that, because that chart showed that the standards in 2021 are the least aggressive over the course of the last 7 or 8 years, which is not accurate. And I think you said this. Somebody said this a couple minutes ago, but the point is, you know, I'm not saying, look, a 5.5% debt yield, stabilized debt yield on a conservative underwriting might make a lot of sense, because rent's going to grow for the next, you know, 7 or 8 years, and you're going to end up being okay. But as lenders, that's not the bet that we're supposed to make. That's the bet that the equity is supposed to make. We're supposed to lend to a, you know, to a place where we feel safe at 65, 75, even 80% levels. But
So I actually advise clients that we have to show it to you, but it's not always the best solution, because if there's any hiccup and there's any bump, I can tell you during COVID, we saw that the lenders that had stability and had ability really were able to work with borrowers. We had the ones that just had, complicated financing structures, had no ability to do anything, and ultimately it's that extra 3 to 5% in leverage you're paying for it, and you're much better off long term on the equity side.
I agree with you. I guess my point is that deals where I'm really what I was thinking when I answered that question was that if you've executed your business plan and someone's willing to give you too much money, right? It's not necessarily wrong to take that money, right? If it's a value add deal, if it's a construction loan, you have to be very careful about who your lender is, no question.
So we do have 1 minute and 33 seconds left, so I'm going to just thank every single one of you. I think this was really dynamic. We have a really great group over here, and I want to thank everyone in the audience. And I'm around for the next day and a half. If you have any questions, feel free. We don't have all the answers, but what we do know is that you've heard it over here. Lenders are out there, they're looking to make loans, and they're looking for good borrowers. And as long as everyone understands what their role is, and I say this for 35 years of my career, you guys don't get paid enough to take inherent risk. So the best thing a borrower can do is perform and follow your business plan and do it well. And they're not your lenders, are not your partners. They're your lenders, and they have 100%, investors on the other side. You talk about the New York. Joe says about the banks coming in. We had one of these banks come in from out of state, and we sent them a deal, and it took like a week. And the guy called me back. He goes, "Oh, we don't think this really works. We're not sure you really understand it, but if we made this loan, it would be considered a substandard loan right away." And I said, "Okay, why is that?" And the guy gave me all his underwriting and all his challenges that he had on the deal. The bottom line is he was 100% wrong because he didn't understand the market. So we are very respectful of banks that understand the markets. We understand the agency space really well. I'm really proud of our relationships with Fannie and Freddie and with Jeff Lee on the NewPoint. We do a lot of business with multi sources on the agency business. My good friend Ivan Caffin was supposed to be on the panel, but I guess Sterling is more important than me, so he's going to be there tomorrow. But he's been a great lender for us on the agency side and also on the balance sheet and understands real estate. And I'm giving him a plug because he deserves it. He's done such great work for all of us. And if he would be up here, it would have been another interesting dynamic. So I thank everyone. Please feel free to introduce yourself. A lot of you have loans with a lot of these banks. They don't know you individually. So please feel free. And John, Jeff, Scott, Joe, and Tony, you guys are not just great bankers, smart guys, good friends. And I appreciate the relationship that we have developed. And it's, one thing that recently, David Brickman said to me, and he's a big name in the industry, he was the CEO of the largest lender in the country, Freddie Mac. He said, being an insider in Meridian, I realized how you care about your lenders, you care about your borrowers, and then you worry about Meridian last. And I tell it to my brokers all the time, and it's something that we've established over so many years. But without our borrowers, we wouldn't be anything. Without our lenders, we wouldn't be anything. Without my brokers, we wouldn't be anything. So it's really just every single one has such an important role. I want to thank you all for that. And enjoy the conference, and let's all stay healthy and be...
Thank you, Ralph.